Hi, welcome everyone to an incredible session about index investments in this current environment. As you know, we're exploring different areas of investment, especially in these turbulent markets. And some of the questions that I receive on a regular basis is, what other alternatives do we have? Where should we focus, et cetera, et cetera. So we covered real estate, we did cover the economy in general. And in particular interest to most of you is index investing, ETF. What does it mean? Is it the right time to do this now? Where is the market going, and what are views on investment in ETF and index? Are there safer alternatives to other type of investment out there? So I had the great pleasure of inviting Angus McLeod, who has great history with Vanguard, and he's going to share some of his view today. Thank you for joining us, Angus.
Thank you, Nitay.
Yeah. And as you all know, Buffett says, if you don't know what to do, most people should probably just own SP 500 low-cost index, and that will be the best investments they've ever done in their life. Of course, he invests in private businesses like Koenig Heritage, but he says, if you don't know what you're doing, on an index fund. Angus, before I ask you to either agree or challenge that comment, how did you get into index investing, ETFs? I know you're very vocal about it. You're a no-nonsense type of guy. I have experienced us being on the same side against fund managers in social media, and you don't hold back. So I'm glad we have the same view and we're not opposite side. But how did you get to index investing? Tell us a little bit about your history.
Okay, my history is I've worked in finance since, well, the 1980s. And during that time, I've been involved in a number of different aspects of the financial markets, interest rates, interest rate derivatives. But I became involved with equities in the late 1990s. I was a computer programmer at a fund manager, and I naturally gravitated towards the passive desk there. So I was naturally interested in index funds because they follow a quantitative process. They don't involve trying to pick the best stocks in the market. They involve trying to build a portfolio that will track whatever market the portfolio is designed to track. So that gave me I had a natural interest in investing in that way. I was able to get a job on the index desk, and I was involved with index funds then for about 12 years at a number of companies, but most recently at Vanguard in Melbourne. Since then, I've moved into the academic side of things, and I'm a lecturer now at Swinburne University and RMIT University, where I lecture mostly in finance subjects at postgrad and undergraduate level. So I have a natural interest in the markets, and I like investing. And I think everybody should be thinking about investing for their retirement and for other long-term goals, and that's what I think the share market is all about. But I think there's certainly a right way to go about it, and that is where fees aren't eating into your investment and where you are getting the most broadly diversified portfolio that you can. So that's my brief resume, Nitay. So that gets me to where I am today.
Thank you for that. And I think we share a lot of, obviously we share a lot of views, like conservative long-term type investments, not doing anything stupid with your money. And I think it's a great for the audience and those who are listening to have Angus with us. Angus, let's just start with a few definitions. And before we go to what's index investing in funds, you have used the term just now. And again, for those of you who watch, we're going to start from a high level and then go a little bit of details. So we're just going to align a few of the definitions. Angus, what does it mean active and passive in the share market investing? Yeah. Because I've seen some gamblers who think they're investing, but they might as well go to the casino and pick red.
Yes, yes, I agree with that. Well, I think all of the people who are listening to this recording will understand and have seen on the TV that we talk about markets. And on the TV news, Alan Kohler will say that the US market was up by 2%, or the European market was down by 0.5%, or the Australian market, usually represented by the All Ordinaries Index on the TV, moved a certain amount. That's an aggregate of all of the stocks that are listed on the various exchanges. So in Australia, the All Ordinaries Index is the top 500 stocks by size. And every day, the stock exchange calculates the value of those top 500 stocks. And by value, I mean the number of shares they have multiplied by their price. So effectively, if you wanted to buy the entire market, that's the price you would pay. And the next day, they make that calculation again. And whatever the difference in those prices is the movement that has occurred overnight or during the day. And that's the movement that gets reported by the news. So when we say that the market has gone up 1%, it means the value of all the shares on the market between yesterday and today has increased by 1%. So if you wanted to be an investor in the broad market, you could get that investment exposure by investing in an index fund. Now, the index fund would be buying all of the shares that are represented by the market that we're talking about. So in Australia, the most common invested market index is called the ASX 200, and that is the top 200 stocks that are listed on the Australian share market. Of those stocks, currently CSL, I think, is the biggest one by value. And then we have things like the banks and BHP, all the way down to number 200. And they are represented by their size relative to the index. So they have what's referred to as an index weight, or the proportion that their value makes up of the broad index. Now, an index fund manager would build a portfolio that was trying to exactly track the movement of the index that is being tracked. So an index portfolio manager who was managing an Australian shares portfolio benchmarked to the ASX 200 would buy all of the shares in the top 200 at exactly the proportion they are represented in the index. So no matter what the prices did from one day to the next, the value of the portfolio would exactly track the value of the index. Now, there's a few little technicalities in there about actually running a fund, which may change your exact performance from one day to the next, but over a year or an accounting period, the difference between the performance of the benchmark and the fund is almost identical before fees. Most index funds are...
we'll come back to the fees. I'm smiling already.
We will.
I know where you stand on it, and definitely where I stand on it.
Yeah.
We'll touch on that in a moment. Sorry, I stopped you. Please.
No, that's fine. Yeah. So that's passive indexing. It's called passive because relative to the index, you are not making any investment decisions. Now, on the other hand, we have active fund managers. Now, an active fund manager has the objective of having performance that is greater than the performance of the benchmark. So if the benchmark goes up by 1%, the active manager will try to go up by more than 1%. Markets both go up and down. So if the market was to go down, the active manager would try to go down by a lesser amount. And they do that by making, I will use this word advisedly, bets against the index weight. So they may choose among the 4 banks, for example, in Australia, that 2 of them are not worth investing in as much as the other 2 are. So they may choose to have no holdings at all in a certain stock, and therefore increase their holdings relative to the index in the other 2 banks, or they might choose to just have a little bit less than the index has. So then their portfolio will perform differently to the benchmark on any day. And an index fund manager, because they're tracking the index, will buy all of the stocks in the index. So of the top 200 in Australia, they will buy all of them. But an active manager will probably get about 50 to 60 stocks and use that as their active performance measurement. And of those 60 stocks, they will be trying to pick those that are going to outperform the index and therefore make their fund outperform. But that's the main difference between index and active. And index is also called passive. In all of these investment world things, there are usually a number of terms which all refer to the same thing. And For indexing, it's called indexing or passive investment.
Thank you, Angus. And we'll come later on to the performance of active versus passive, because I think that's an important topic to discuss, and especially the fees, which I know both of us are aligned on. But before we do that, a lot of people, and again, whilst you and I know the definitions, a lot of people hear different terms like ETFs, index mutual funds, and some other type of vehicles, investment vehicles. Mm-hmm. Do you mind spending maybe 30 seconds or a minute or whatever time you think is appropriate, just to kind of align the definitions around, hey, this is what ETFs is, this is what index is, and et cetera, et cetera?
Yeah, certainly. Well, if we begin perhaps at the bottom, we have mutual funds, and mutual funds are investment funds where investment funds from, so money from many different investors are pooled together into a mutual, usually a trust structure. And then the money is invested as a pool. And those trust structures are usually involve having units in a unit trust, and there are various legal requirements to do with that. So active or passive are usually incorporated as a unit trust type of legal structure. Up from that, and as an investor in a unit trust, you would either deposit money. If you're old like I am, you would walk in and put a check over the front counter, or you could transfer money to that account, and you would be transacting with the fund manager who was managing that fund. If you wanted to take your money out, you would ask them to process a withdrawal for you, and a couple of days later, they would send you the redemption amount that you had requested. Since about the early 2000s in Australia and the late 1990s in the US, a different vehicle has emerged which offers access to the same mutual fund structure, but via a different channel, and that's called an ETF. An ETF means exchange traded fund. So it's a way of buying and selling units in a mutual fund, but doing it in the stock exchange, not directly with the manager of that mutual fund. So you would be transacting with either another person who was trying to sell their units in the fund on the stock exchange, just like you would be buying and selling shares in any other listed company. The ETF structure has some advantages in that there can be some tax advantages involved in the way that the ETF is managed by the market and the way the tax laws apply to that. But the other advantage is that you can transact at any time during the day. And the other big advantage of an ETF is that if you have some sort of online portfolio management system, whether it's Commonwealth Securities or any of the online portfolio management tools, or you are going through a financial advisor and they have a platform to manage all your investments, it's very easy then to consolidate for tax purposes and performance calculation purposes all of your holdings, because the ETF is listed and for all purposes, it looks just like a share. And that's with ETFs. Most ETFs originally began as index ETFs, so passively managed funds. In the last few years in Australia, we have been seeing the listing of actively managed ETFs. They also go by some other names on the stock exchange, like M Fund, which just means mutual fund, but it's listed on the exchange. And the process of moving all these funds onto the exchange is principally to lower the cost of them. And it takes some overheads away from the actual mutual fund manager. They don't have to run a unit registry for you. They don't have to keep track of your account. It's all done through computer share or link market services, so through an external party. So none of the costs of managing that fund fall onto the manager, and then they don't have to be passed through to the investor. So ETFs can be a much cheaper investment vehicle than their equivalent mutual funds. And one other thing that's worth mentioning is that for many ETFs, the pool of money that is the mutual fund is actually the same pool of money that the ETF is invested in. So it's in effect just another class of units of the mutual fund. And it's a class of units that attracts a lower fee than investing in the same mutual fund. And the way I like to describe that, Nitay, is to say, buying an ETF that is attached to a mutual fund is like going to the same movie theatre to watch a movie with the same people who are invested in the mutual fund, but you've come through another door and the ticket price is cheaper, but you're actually getting the same investment exposure. You're seeing the same movie at the same time as the other people. So it makes a lot of sense to use an ETF because you see the same show for a cheaper ticket price.
Yeah. And obviously there's some tax advantages of owning the equivalent of a share in a stock exchange as opposed to other vehicles. But that's tax driven. That's not.
That's not necessarily a up top investment decision.
Correct. It's an administrative decision.
Yes.
Thank you very much for that. And you broadly started to touch on the advantages and disadvantages. And I think that's an area, with your permission, that I'd like to delve a little bit more into it.
Mm-hmm.
So with index funds or ETFs, and I'll use those broadly in terms of the definition. I mean, what's some of the obviously I'm aware of the advantages and disadvantages. Let's assume I'm a newbie. I don't know anything about index funding or ETFs or anything like that. What are the real advantages and also the disadvantages that I need to think of before I even do an investment of that type? For example, let's just say, let's summarize it so far. I assume that, okay, I'm not a share picker. I don't know which shares can go up and down. I don't have the capability to do it. I think it was Charlie Munger who said, if you walk in life with a crystal ball, you end up walking barefoot on shattered glass. So I don't know. I'm a stupid investor. I always said I was. But that mentality is important because you don't outsmart yourself, right?
Yes.
I understand now that passive investment is for me. I know what index investing or ETFs investing is, broadly speaking, thanks to your explanation, Angus. What do I need to be aware of in terms of advantages and disadvantages?
Okay, well, with passive investing or index investing, whether it's through an index fund or an ETF, an investor is getting exposure to a broad market, whether that's the Australian index and you're getting exposure to the top 200 stocks, whether it's a US index where you can get exposure to the top 500 stocks or even the top 3,000 stocks in the US, or whether you're using this index fund to get exposure to perhaps a narrower section of the market. And we'll talk about the different types of products that are available later on. But if you have decided that from an investment point of view, you do want exposure to a certain part of the investable market, so for example, the Australian stock market, by investing in a mutual fund that is passively managed, you are getting the broadest exposure you can because you are investing in the top 200 shares of the market. So you have what we like to call in university diversification. And that means if any one of those 200 companies happens to perform poorly or at worst go broke, you've still got the other 199 stocks in your portfolio. My grandmother used to tell me to not put all my eggs in one basket. Now we call that diversification. And that's why being invested in a broad market index gives you that extra protection. So once you've got that protection of the diversification, you also have, with an ETF or an index fund, the transparency of knowing what is inside your fund. The ASX 200 stock list is publicly available information. The fund managers will make it available to you. So you know at any time what you're actually investing in by buying an index fund or an indexed ETF. An active fund manager won't necessarily tell you until perhaps a month or two lag, what has been included in their portfolio to give you the performance that you have received.
And
So
that's important, Angus.
yeah, I think the transparency factor is very important.
Yeah.
Most fiduciaries would want to be able to explain to their client what they were invested in. So as a client, it would be very important to understand what your money is being invested in at any time. And that's one of the big advantages of these passive vehicles, that you do know what your money is invested in. So if we take the diversification and that good transparency, and we add to that the cost effectiveness of an index fund or an ETF, an index fund or an ETF charges an extremely low fee, particularly relative to an active manager. And that's because the only research that an index manager needs to do is to find out what the index weights of all the stocks in the portfolio are from one day to the next. But an active manager will be spending money on analysts who are analyzing and probing into individual stocks. They are spending time and money speaking to the management, running their investment process, which probably involves a lot of spreadsheets and a lot of talking and thinking. It also involves, for a very good active manager, going to visit the investments that they're making. And one example of that is a fund manager I used to work at, the active investment team there, had some mining analysts. And they would spend a lot of time going to the mines in Western Australia. And that involved flying to Perth, flying to the mine, spending time away. They were able to get some insight into the company, but it did cost a lot more for that investment and research process to be undertaken. So the fees on an active fund are generally much higher than the fees on a passive fund. For example, an active fund fee could be more than 1%. But a passive fund fee could be around 0.25% and even less with an ETF. And something that I'd like to point out about fees, and Nitay, is that many people think 1%, that's not a lot. But 1% compounded every year for 25 or 30 years adds up to a lot of money that is going to fund the lifestyle of a fund manager rather than your lifestyle. And it's possible to calculate what this 1% compounding over a long period of time is, and you would be surprised if you actually did the exercise.
And Angus, sorry to step you. I want to echo your thinking here. I completely agree. And with full disclosure, I had funds before, and one of the main reasons I moved away from a fund management to a company, to a holding company in terms of Koenig Heritage, is to remove those fees. So for example, internally we run at cost. Whatever it costs to run a company, that's what we do. But we don't have lifestyle decisions as opposed to investment decisions, which unfortunately, in my humble opinion, a lot of fund managers have to tackle. You know, do I distribute this 2% to myself, or do I leave it into further investment in companies? And I would never, ever want to be in a scenario where I have to debate, do I take a fee or do I invest in the asset? And that's why personally, I am now against, in my world, the private equity type fee model. And that's why we've done Koenig Heritage the way we do. But I echo your thoughts on any fund manager. You need to seek the best one in terms of performance, but also in terms of fees.
Yeah. And with your penchant for quotes, Nitay, there is one that involves JP Morgan showing somebody around all of the boats that were parked in the harbour in New York. That's my yacht. That's that's Bear Stearns' yacht. That's and the customer said, but where are the customers' yachts?
Well, and unfortunately, I mean, I know it's not index funding and ETFs particularly, but unfortunately in Australia, we had seen some shockers. I think most recent in the papers is Mayfair's 101, Blue Skies. I mean, you name it, Australia, unfortunately, have it.
Yeah.
It's an epidemic, in my opinion.
Yes, it is.
Unintended.
But the interesting thing about the fee doesn't sound like a lot of money. And to many people, 1% doesn't sound like a lot. If you went to a shop to buy something for $100, and they said, "Oh, guess what? It's 1% off today." You go on, whatever, I don't care. But yeah, because
once it's compounded, that's the issue.
General investor's brain does not fully comprehend compounding until it's shown to them on a calculator.
I think it was Buffett, my friend over here, who said compounding, I think it's him, correct me if I'm wrong, is the seventh wonder of the world or something like that, right?
That quote gets attributed to many people, including Einstein, but whatever it is,
you can attribute it to me, that'll be fine.
Yeah. And says, yeah, well, maybe the both of us, we can share the credit on that one. But it's true. Compound interest is an amazing thing. I teach it at university, and even when I look at the results, still, I think, look at that.
And the funny part is you don't see it in the first 5, 6, 10 years, but later on you see the gap and then the penny drop. But and we'll touch on it later because this is relevant for today. That's the long-term perspective that you must adopt if you are a passive investor. And I know you touched on diversification, on transparency. Now you're talking about the cost effective of index funding in terms of the fees, and I agree with you. Yeah.
Yes.
And we'll touch on the long term later on. Sorry, I stopped you. Please go ahead.
That's fine. And the final point that really comes after the diversification benefits, the transparency benefits, and the cost effectiveness. And we will talk a lot more about fees, but if you've decided that exposure to a certain market, Australia, US, subsector, what is the right thing for you, then the last thing you want to do is to be giving away your performance. And there's two ways to do that. An index fund will always give you the performance of the benchmark, which is the investment you've chosen to make by going into an investment that is benchmarked to Australian shares, for example. An index fund will give you that performance exactly and take their little fee out. But an active manager, because they're not holding all of the stocks in the benchmark, will have a different performance to the benchmark. And yes, their objective is to outperform the benchmark. Sometimes their objective is to outperform by quite a lot. Unfortunately, not having the same portfolio as the benchmark is a sword that cuts on both sides. So often, the performance of an active fund manager is substantially below the index, and then they take their fee out, so it's even lower than the return on the asset class that you thought you were investing in. And that is one of the, I think, the biggest advantages to indexing, in that it gives you the performance of the asset class that you have chosen to invest in. And all the investment theory going back to the 1950s says that broad allocation to various asset classes, and importantly, the way you mix them together. How much of your portfolio is invested in Australian equities, US equities, Australian bonds, US bonds, and all the other components is the primary driver of overall performance in the long term.
Does this then make you a macro investor, Angus?
I suppose it does, because you are implicitly ignoring the microeconomics of all the companies that you're investing in. For an index manager, I managed a portfolio that was invested into stocks in Japan. Japanese stocks don't even have a 3-letter code. So on the Australian market, I know that BHP is the code for BHP, but in Japan, the stocks are just 5 numbers. So all I needed to know was the list of the 5 numbers and the list of the weights and invest in it. I just knew I was getting exposure to Japan. I didn't know which stocks I was buying necessarily. And that's how passive investing works. You are being exposed on a macro basis rather than a micro one.
But that leads me to the other side of the coin here, right? I mean, on the one side, there's all the advantages that look gold. There are some disadvantages to this as well. Mm-hmm. And for example, by your statement, as an index investor, you just want a list of numbers. You put it to, say, whatever, top 200 companies, the list of numbers in Japan index, and that's what you do. You don't necessarily know what company do. You know the top 200.
Yes.
What are the, which sounds good, obviously over the long term perform better, but there's some disadvantages to that. And I'm curious to know.
Okay,
Not all rosy.
That's a fair question, and it would be wrong to say that I have found in index investing the perfect investment for everybody, and I think many people would think that's the investment that never goes down. Look, the index goes down from time to time, and we saw in March this year globally with coronavirus that many of the indexes fell. A passive manager has the objective of keeping all of their money invested in the market at all times. So when I ran an index fund, 99.9% of my money was invested. So only 0.10% was
because
not.
you're not waiting for an opportunity, you're buying the market.
That's right. Yeah. But a fund manager that is managing an active portfolio can always, if you like, hide in cash. So if he thinks the market is about to fall, they can pull their equity investment away and leave your money in cash. So that is the advantage that an active manager can do. But the counter argument to that is that's possibly something that you should be doing as an investor. If your active fund manager is going to put 10% of your money in cash, but still charge you the fee as if you're managing your money actively.
That's right.
Some might think that there's a conflict there.
I'll be less polite, and I'm going to use professional language here. That is just stupid.
Yes, well, perhaps.
Why would I give it to someone to charge me 2% or whatever amount he charged me a year when they keep it in cash, when I can put it in my own bank account and the yearly fee is whatever, 150.
So that's.
I'm not allowed to say stupid, but I'm the less polite one.
Yes. So that's probably one of the disadvantages of ETFs. Some people might say also that the way an index fund is constructed is that the stock with the highest weight is the stock who's has the highest value in the index. If for some reason that stock's value is being artificially inflated, its weight is increasing in the index, and an index fund manager will be putting more new money into that relative to the rest of the index. So some give the argument that overvalued stocks, so stocks that are temporarily overvalued, have too much money put in them, and stocks that are temporarily undervalued have not enough money put into them. But that ignores one of the central tenets of passive investing, and that involves around a technical thing that we call the efficient markets hypothesis. And in a nutshell, what the efficient markets hypothesis says is that every stock is always perfectly valued at any time, and that every piece of information about that stock is incorporated in its price. And it's only when a new piece of information comes along that the stock's price will change. I don't think that every passive manager lives that as an article of faith entirely throughout their lifetime, but it's one of the things on which index investing is predicated, that the market is rationally pricing every stock at any time. So there is no concept for an index manager of this overvalued, undervalued.
Angus, I'd like to unpick this just a little bit more in terms of the weighting, right? How does an index manager, say you have 100 million or whatever the funds, call it $1, call it $10 for the $100, it's easier. And you have $100 that you need to allocate to the index. In terms of weighing, like, do you buy more of the bigger one? Do you buy more of the smallest one? Do you buy them equally? How do you then approach it? So that's question number one. And question number two is, if you're weighing toward the upper level, that creates a distortion. For example, in what you see like Amazon and all the other big companies in the US at the moment, you see this big growth in the particular index that they are, but it's mainly driven by 5% number-wise of the companies as opposed to the 100 companies that are.
Yes.
So I'd love to hear your comments on this for the benefit of our audience.
Okay. Well, the first question was, how does the fund manager allocate the money in an index fund? And I have in front of me now a list of the top 200 stocks in Australia. So on the 1st of June, when this was calculated, CSL had a weight of 7.49%. So Commonwealth Bank had a weight of 6.55, and so on down the list. And the smallest company in the top 200, so number 200, is a company called Estia Health at 0.02%. So if I had $100 coming into an index fund on any one day, I would buy $7.49 worth of CSL, $6.55 worth of CBA, 78 cents worth of Sonic Healthcare, and 2 cents worth of Estia Healthcare until I'd spent my whole $100. So that's broadly how an index fund would work.
But how do you determine the weight?
I determine the weight because 4 times a year, Standard & Poor's, in conjunction with the Australian Stock Exchange, and a well-published set of rules, decide which stocks will be in the top 200. And it's decided simply by calculating their value. So the size of the company, CSL, the number of shares it has on issue, and the value of each one of those gives me the dollar value of CSL. If I add the top 200 of those up, I get the dollar value of the top 200. And then it's simply a matter of dividing each one by the total to get its proportion of the index weight. So the index weights add up to 100. And right now, well, on the 1st of June, CSL was about 7.5%. Those prices change every day. And so I can recalculate the weights every day. And if there was a substantial change in price in CSL, say it fell and it became smaller than 7.5%, I would then only invest the index weight every day into that stock. And an investor, a manager rather of an index fund, only needs to make a trade if there is money coming into the fund or money going out of the fund. If on the first day you invest all of your money into all of the shares at their correct weights and you never get more money coming in or out, then every day each stock will always be at index weight. So it's only on cash flows that a fund manager has to trade. There's a small technicality there in that it would be costly to trade all 200 shares in the index every day because we're paying brokerage on those trades. So most fund managers, and where I was, we had a system that would find the best list of trades to do, which minimized the brokerage. So on a portfolio benchmark to the ASX 200, we might be able to, on any one day, simply buy about 20 or 25 stocks, depending on the amount of cash that was coming in, because it got our holding weights within a certain tolerance. And there was, a lot of technical mathematics and a few technical terms involved in calculating those things. So we would always be managing our portfolio to within a very close tolerance to the index rather than to be exactly replicating it every minute of every day.
Thank you, because I do think the weighing question can impact the index or the manager allocation.
Well, no, because it's just whatever the weight is today. So it's just simply you're buying that stock on its proportion that it makes up of the index.
So essentially what you're saying, whatever the index weight is, that's what you replicate.
Yes.
Okay,
yes.
That's fine.
And 4 times a year, every quarter, Standard & Poor's or whoever the index provider is, there is about 3 or more globally who do this, recalculate the index. And it could be that the stocks between 190 and 210 might change places.
Would that stop things like, and I'm using Amazon here because everyone knows it, and perhaps it's huge now to have a negative effect, but does it then accommodate for out of the chart performance of, say, 5 companies in the index in terms of?
Well, if you're invested in the index, you are getting the return of every stock. And I think the important part about that point that you make, Nitay, is that if 5 stocks out of 500 in the US are driving all of the share market performance, and you've got an active fund manager who's trying to pick a few hundred of those, how do you know he's picked the 5 that are driving all the performance?
You don't. You simply don't. No.
Yeah. But if you buy an index fund, you are going to get the performance of those top 5 stocks. The founder of Vanguard, a gentleman named Jack Bogle, who died a couple of years ago, again, favoring one of your quotes, he said, there's no point finding the needle in the haystack, buy the whole haystack. And
it'll be cheaper.
Yeah, well, and it's cheaper. The counter argument to that is I got lucky and I put all my money in Amazon and Facebook and Apple 2 years ago. But that's just a fortunate coincidence.
I see so many in my day-to-day job. I see so many, I call it hindsight spreadsheet warriors.
Oh, yeah.
Which really all they've done is just got lucky. Yeah.
Yes.
No fundamentals, no real thematic around what they're doing. And I see it over and over and over again. And perhaps when I had longer hair and I was slightly leaner in weight, I had the patience to entertain what they're discussing, but less so. So I agree with you, and I think I know where you're going. They just got lucky.
Yeah, they just got lucky. Walk down to the casino at 2 o'clock in the morning and see people coming out with a smile and ask them how they did. They'll tell you about all the winning hands. They won't tell you about any of the hands where they lost money. But
it's not just that. You go, if they come to you on Tuesday, you go to them on Thursday and say, how you going, mate? And I'm not sure that they still have a smile on their face.
Well, then they'll tell you about Tuesday.
That's true. Thank you very much. Okay, so that gives clarity, and I hope to those of you who watch at home about what is even in index funding and investments, and then what some of the advantages and disadvantages of them. And thank you. That was very, very clear, Angus. And I hope you, the audience, got some benefit from it. But the key question from my end, and I'm sure from those who's watching, performance. Yeah, if we take a sample of the best active investors on the stock exchange, obviously not private investments, but listed investments, how is their performance in comparison to me, person who can't pick a winning horse over the longer term?
Well, it's funny you should ask that question because Standard & Poor's, who calculate the index in many places around the world, also do a comparison of active managers versus index managers. And it's called the S&P Index versus Active report. And it turns out that in general, of all the active fund managers who promise to their clients, well, let me rephrase that, whose objective is to outperform the index, around about 86% of them fail to do that. So 86% of active managers who charge a big fee and promise to outperform the index don't actually fulfill that promise. And it turns out also that the biggest drag on their performance and the main reason that active managers underperform the index is the fee that they charge. Most active managers underperform, well, track the index before fees, but after they have taken their management fee out, you are left with a portfolio that is not.
I missed the period that you just mentioned.
I'm looking right now at one of the reports for 2019, and in the US, over 10 years, those numbers apply. Around about 85% have not beaten the benchmark over 10 years, and we can drill into that even more regionally and in other so in Australia and in other places. But it turns out that in general, active managers do not fulfill their objective.
I've seen the statistics, and I can't recall where the origin of that from, but I can fish it out to those of you who are interested. But after 15 years, approximately 92% underperform the index. So
Yeah.
think about it. If you have, and the reason I mentioned it, 92% underperform the market. The reason that's important, so if you have in your, if you're still in your working life and you're in your 40s or whatever age, and your super fund is allocated to active share manager, 92% of them are going to lose you money. Quickly share my screen. You see some of the statistics around active investors and passive investors, i.e. index funds, and let's call them share pickers. And if you look at the history, just going back to the statistics, in 5 years in the US, only 19% of active investors outperform the S&P 500, which translates to 80% failure in 5 years' time to perform over the S&P 500. And I think those figures speak to themselves. And if we look at Europe, it's not that different. Nearly 80%, 77.54, underperformed in a period of 5 years the European equivalent of the S&P 350, though, in this case. And in 1 year, it's 71, so that's even worse. And if you look at Australia, which is really where most of our listeners are from, it's a staggering numbers. 80% failure. Let me just repeat this incredible number. 80% failure to overperform over the ASX 200. Now, you don't need to be too smart to think, am I going to gamble on the 19% that can overperform the S&P, the ASX 200, or do I go with the 80% that fail? Now, if you look at other countries, it's not dissimilar. It's fairly consistent in terms of, this is a staggering number, 97% failure in Chile, India, 82%, and again in Australia is about 80. It's quite consistent around the world. Angus?
Yeah. And look, I find that to be one of the most compelling reasons to invest in passively managed investment vehicles. Something that's not immediately apparent from those raw numbers is that they are all calculated before tax. Because tax is a complex question for a fund manager. They don't know the tax rate of the individual investors in their fund, so it's easy for them to publish a pre-tax number. An active fund manager will be buying and selling, so turning over their portfolio is the terminology, up to, well, they might turn over in value up to 200% of the fund. So if they might be buying and selling stocks, effectively washing the portfolio twice per year. An index manager will have a turnover of about 4 or 5%.
That's right.
Turnover creates tax parcels. Some are lost, some are tax losses, but some are tax gains. So after tax, the performance of an active fund is even lower than the published performance. So it's not about, and this is something investors should remember, and it's something that I would expect active managers should remember a bit more too, given they're usually highly qualified. They like to think of themselves the smartest people in the room.
Well, they do drive a Lamborghini from your money.
They do drive nice cars, yeah. That's
that you're paying for.
Yeah, but none of them seems to take into account the effect of capital gains tax on their portfolios. And an investor can't eat published performance. An investor eats what they get in their bank account at the end of the year, which is often very different to the published performance from all fund managers, but the tax effect is much larger on a fund that turns over a lot every year. And that is an active fund, because they're continually buying shares, watching them go up, selling them again, and they don't care about tax. They're like our gambler who just comes out of the casino at 2 a.m. and says, "Look at my fund."
I mean, you know where my views on it, and I personally, and it took me at the beginning of my career, I certainly wasn't of that view. Perhaps it's the young age and naivety that was early on. But my view is, if you buy an investment, and not just an index investment, any investment, my personal view, don't invest for 12 months or even 24 months. Invest forever. I haven't coined the phrase forever. I wish I have. But greater people than me, like the gentleman over there, coined that.
Yeah.
And my view is, for example, when you buy your home, why is it different than buying an investment? You don't value your home every second day. You value it when you buy it and when you need to move to a bigger house.
That's right.
Or condition, your requirements change, or whether you're downsizing. But you don't go and value it every day.
No.
You don't
No.
sit there and go, the house, we need to sell.
Yeah.
So, and it's an interesting one. Why is it different in investment? I don't think it's any different. If you invest for the long term.
Yes. I think a number of things, the availability of everyday pricing. Everybody got access to the stock market, either on their phone, their computer. Previously you had to walk down the stock exchange or wait for the newspaper to come out, but people see it all day, every day now.
That's right. It become gambling. On the lower level, it just become gambling. And my argument on the higher level, it becomes a game of who can outperform each other, not actually make money. You're trying to outmaneuver other people, and we've seen the trend of nano trading and the second trading, and it just becomes so complex. Yes. And they forget that there's an asset underneath that you need to check the fundamentals of what the hell is happening there.
Yeah, well, that's right. And often active managers say, "Oh, I outperformed the index by 25 basis points this year. My investors must be happy." But if the index went down 50%, like it did in 2007, well, your investor doesn't care that you beat the index by 25 basis points. They've lost half their money. So right. I think fund managers should bear in mind the absolute performance, not just the relative performance as well.
Correct. Correct.
Particularly in the down years.
I think we discussed about, unless you have anything else to add on why you think they're not performing.
No, I think that's pretty much it. Yeah.
I guess you mentioned the word long-term, and I'm obviously a long-term conservative investor. I know you are too, Angus.
Yep.
But I suspect for people who are exploring based on this conversation, if you're anyone watching today, and you're thinking, hey, I would like to get exposure to index funds or ETFs or similar vehicles, Angus, I think it's important to note to them, and especially in the current environment, and I'd love you to spend a bit of time on the current environment after this statement, you need to look for the long term. Otherwise, it doesn't work.
No, that's right. And as you said, one of your heroes there said that the correct holding period is forever.
Correct.
And that's certainly a philosophy that I would believe in. And if I bring a chart up onto the screen now,
sure.
Nitay, you can see here, this is a chart provided annually by Vanguard, and I will declare my interest. I worked there for a decade. Vanguard likes to show the effect of long-term investing. And yes, we've all seen that the markets come and go. If you were around investing in 2007, you saw a big change to the negative. Earlier on this year, we saw a big change to the negative. But if you look at the lines on this chart, you can see that starting in 1990 with, they're using the growth of $10,000 here. In every asset class, the long-term performance has been an upward trajectory. So inflation has gone up. So if you were investing at the inflation rate, you've got $20,000. But if you put your money into cash, cash has had a compound long-term return of just over 5%. So you've turned 10,000 into 44,000. And even by removing the effect of inflation, you've still doubled your money. And if we look through the different asset classes, international shares are up 7.3% per year. Australian bonds have been performing very well, particularly in this last 10 years as interest rates have been falling so rapidly. But listed property, Australian shares, and finally US shares have all outperformed, or have all performed rather, remarkably well over that time. Yes, there have been ups and downs, but for an investor, the long term is best. And it's easy to say that if you're age 20, there are some other caveats that might come in when you might be an older person who doesn't have the time to see your investment recover from a low. If 2007 was a particularly low point. But in that case, asset allocation and removing risk from your portfolio and perhaps investing in more defensive assets like bonds and cash rather than aggressive ones like the equity market would probably be the right thing to do. So as you get older and closer to retirement, you should be removing the growth assets from your portfolio and looking to preserve your capital by investing in things like bonds and cash. But yeah, importantly here, I think this shows over 20 years that in fact 30 years, the general direction of the stock market and all investment markets is upwards, with some blips along the way, granted.
And this is with recessions in between.
Oh yeah, this is from 1990, so we started with a recession. Right. International shares is in the purple line. That dropped like immediately, as did the Aussie and everything, but it's continued up through the 1990s crash, the 2000s crash, the 2007 crash, the little mini crash we've had now. You're still better off to have been invested in the markets that entire time than to try to come and go, time the top of the market, time the bottom of the market. Investors who feel that they can look at this chart and go, oh, well, I would have got out there at that high point and I would have got back in there at that low point. They're actually backing themselves to make not one well-timed decision, but two. And the research into things like behavioral finance, and that's a whole new field of research into how investors behave, which is quite enlightening about what investors should be doing, and as against the things that they actually are doing. You can see that by staying invested, it's Vanguard would always say it's the time you have in the market, not timing the market, that is important for an investor. So a long-term strategic asset allocation and the ability to choose that asset allocation and stick with it. So to effectively turn your back on this chart and only look at it 10 years later and go, look, it's all good, rather than be caught up as you so correctly mentioned earlier on, in watching the market every day and going, oh, I'm up, down. Oh, I'm down a little bit. Should I get in? Should I get out? The long term is what equity market's about. And investing, in my opinion, necessarily involves the long term. Trying to buy the market on Monday and sell it on Friday so you can drive a helicopter to your beachside mansion is the stuff of fantasy. It doesn't happen to many people. And good luck to you if it does, but it's probably luck rather than anything else that got you in there.
Okay, I'm just going to stop the sharing.
Yep.
So thank you for that. That's actually an eye-opener chart, Angus. And I think to those of you who watch at home, it goes back to some of the statements you heard me say before, and Angus, I'm sure you will echo that. You must invest for the long term, and you must have the right fundamentals, and you must have the right, and this is the difficult part, patience.
Yes.
And unfortunately, as human beings, we are tempted. When we see a little bit of red in the sky, we get afraid, then we react and we sell or we buy, or when the market goes up, we should probably buy Amazon. Just take a deep breath. So Angus, if you can share this slide with us, that would be fantastic, because I'll distribute to whoever wants it. And I think that's an eye-opener and a reminder, be patient. And remember, even though the market doesn't look good even today or yesterday or tomorrow or next week, it will continue to improve if you hold and if you're patient and if you have a long-term investment strategies. Don't be reactive. That's the biggest tip I have to people.
Yeah, I think that's exactly right. Yeah. It's very easy to get jumpy, but try not to do that. So it's, I think the three good words are, time in the market, look out for your fees and be very patient and understand that it's a long-term investment horizon that you have.
So before we reach the end of today, I mean, there's one particular area that is important in light of the discussions that we've seen. In light of the last segment that we just done, talking about patience and long term. Mm-hmm. Obviously, the current environment is nervous. It's not ideal from an economic point of view. There's a lot of uncertainty. when you talk to people, depends on which side of the road they are. If some people say, oh, the market is fine, it's just going to keep growing. Some say, hey, a deep depression, I've heard the word depression as well, is coming. You know, this is the end of the world. You get the doomsday and you get the hippies. You get the two, and in between, there's different views. What does it mean to, I know the answer, but I'm keen to hear, sorry, I think I know the answer, but I'm keen to hear your views here. What does it mean to index funds? Are they too expensive now? You know, should we wait for a crash? Do you usually perform during a crisis? Now, I know these questions seem to be silly, but I actually get them from audience, and especially in light of the chat that we just saw. Thank you for sharing. But I'd love your comments on it.
Yeah, well, I think one of the difficult things, and it goes to many of the subjects we've talked about today. If you're looking at the market performance from one day to the next and being very jumpy about is it too high or is it too low, that microscopic view can cloud the view that you get when you look at that chart that we showed previously, that in general, the markets will go up. And that's a general statement, and it's certainly not a guarantee, but over the long term, markets tend to be higher today than they were previously. So it comes down to your decision to invest in equities or bonds or cash or any of the assets that are available for you to invest in broadly. If you feel that exposure to equities is the right thing for your portfolio in the long term, then buying the equity market now should satisfy that investment decision you have. And if, for example, the market corrects, and that's just a fancy word for goes down, if the market goes down in the next 6 months and you're 5% or 10% lower than you were, then that's par for the course of equity markets. By investing in it, you understand implicitly that markets go up and they go down, but in the long term, they go up. This chart is income and capital appreciation, but no matter what you're invested in, you will get some income along the way, and the capital appreciation will come in the long term. So to ask whether the market is overpriced right now, to ask me as an index fund manager and someone who feels that, one, long-term investing is the right thing to do, and two, that the market is priced correctly pretty much all the time. If I want exposure to equities, I will get in now. Now, there are some other strategies that people can employ, and that is, don't put all your money in today. Perhaps an investment strategy is to actually keep investing regularly. So if you're putting in some money to an asset class every month or every 6 months or even once a year, you are changing the kind of average price that you're buying into. And you know, there are various strategies for averaging in, or dollar cost averaging, I think is another term for it. So I think many people, again, confuse long-term investing with short-term speculating, which is putting a sum of money down now and hoping that it pays off quickly. Investing is, many people want to get rich quickly. I think most people should take the advice that it's better to get rich slowly, and it takes a long time. I would love to have had a Harborside mansion, a jet, 5 Ferraris, and Armani suits coming out of my wardrobe when I was 25 years old. It didn't happen for me. It happens for some people, but it generally doesn't happen. So
and I tell you now, it happened to them because of a lot of hard work, blood, sweat, and tears.
Maybe it did.
Not because of buying Amazon stock in 1996, because they knew that stock is going to.
Because nobody knows the future.
So the next question I have, and thank you for the time you dedicated today. And this is my last question, because now for the audiences who are not familiar with index funding, ETFs, mutual funds, etc., they have clarity. They know what it is. They know what the advantages and the disadvantages. They know why index funds usually overperform active fund managers. But say, you convince me, I want to go to an index fund. Where do I start?
Where do you start? Okay. Well, you start by, if you have a financial advisor, speaking to them, but if you are going out on your own and you would like to invest in an index fund, in Australia, there's only a few people who offer index funds to the general public. One I used to work for, Vanguard. Another one is called iShares, which is part of the BlackRock organization. So BlackRock or iShares, that's the same kind of product issuer. And there are some smaller ETF providers who also have some ETFs. Now on the market, Vanguard is probably the leader. They have the most funds under management, so they have the largest amount of money invested in ETFs in Australia. They're not the biggest globally. I think BlackRock or iShares are the biggest globally. So Vanguard does offer these types of investments. There are other companies that offer ETFs. One is called Beta Shares. Another one is called Van Eck. They're a global European-based ETF provider. Another local one called ETF Securities. And they have a number of different products that they offer. The big providers, the big global providers, iShares and Vanguard, all offer broad market. So the full Australian market, the full US market, the full European market. They both offer a full global market. So there is a global large capitalization companies index that they both have products that follow. I used to manage a large cap global markets portfolio. So that's about 1,700 of the largest companies from developed markets around the world. But some of these companies also offer some more niche products. Some of them offer products that are in sustainability type indices if you have some particular ethical constraints on your investment. Some offer investments that will track indices that offer a high dividend yield, if particularly good for people with low or zero tax rates. And in Australia, they will often invest heavily in companies that have high franking credits. There are funds that invest in, say, just the top 50 or the top 20 stocks or small companies, emerging markets, global emerging markets companies. And then we get into some of the more strategic funds, which might be involved in technology indices, healthcare indices, pharmaceutical type indices. And they've also got currency ETFs and some other ETFs that track some quite narrow indices. Some might refer to them perhaps as a little more of a speculator's product than a long-term investor's product. There are a number of gold ETFs, and obviously the gold price has been performing quite well in the last few years. But all of these products are out there to be invested in. They're all available on the stock market. Increasingly in ETFs, what you're looking for from the sponsor of the ETF is that they have what I like to call the 5 Ps, and that is that they have a strong parent company, that they have the right people running the fund, that their process for running the fund is sound, obviously that they've got good performance, and finally that they are charging the right price. Now you can get an Australian shares ETF from, I think it's Beta Shares, for 6 basis points a year, so 0.06% fee. The fee on an equivalent index fund might be around 20 if you're going to the mutual fund, not the ETF. So there's been some very strong price competition that is lowering the price of ETFs.
Because I assume it's a technical investment for them. They don't need to do any analysis.
As I mentioned at the very start, all the fund manager needs to know is the stock code and the weight of it is in the index at any day. And if money comes in or money goes out, they just invest the funds accordingly. And there's a whole different mechanism for how ETFs work on the market, which is probably not a subject for today, but maybe worthwhile looking at a later date. But from an investor's point of view, that little step between the fund manager and the market is almost not relevant. It's almost like knowing what's going on inside your car engine between the accelerator and the wheels. Just know that it works very effectively. to keep the ETF priced correctly, so it never really moves out of fair value. But yeah, all of these things are very technical investments, and it's very system-based. So the process that the fund managers have is very important. I know that when I worked at Vanguard, we built, and after I left, they built some even better systems for managing these things. Very automated, automating a lot of the process.
Yeah, I would assume it has to be automated.
Yeah,
charge 0.06% of.
Well, that's it. Yeah, and that's what helps to bring the price down. If it's
with technology as well, I mean,
yeah,
that will only drive it lower and lower.
I think so. Well, in the US, some of the stock market ETFs there, the broad US market ETFs are down 2-1 basis point fee.
Wow.
There was one ETF provider that came out. It's not doing it anymore. It was a loss leader for them. They were going to pay you 1 basis point above the index return to use their ETF. I think they've stopped doing that now.
Yeah, they would.
Yeah.
Angus,
so there are any number of vehicles for investors to use depending on their particular market, either broad market or market segment that they would like to invest in. And there's really too many to talk about, but there are a list of them on the stock exchange website. Financial
any popular ones that, at least in Australia, or?
Well, the popular ones in Australia, as far as I'm aware, invest in either the Australian broad market. So they're both very strong. They're State Street, Vanguard, and iShares all have a very popular Australian shares ETF. Many Australians are now, again with ETFs, seeing the benefit of international investing. Australian market is about 3% of the opportunities in the global share market. So 97% of the investment opportunities are elsewhere in the world. So with broad global market ETFs, that allows an Australian investor to use Australian dollars to buy an Australian-based global market ETF.
That's right.
And that has certainly opened up the world of investing to Australians. Also now that there are bond investments, so fixed interest investments, which previously were for large investors, with lots of money or institutions, and actually investing in some sort of bond fund for your kind of general retail investor was not something they did. Now there are, in fact, bond ETFs which trade on the market. So they're using some sort of investment in domestic or global basket of a lot of fixed interest securities. Some are government issued, so they're very, very strong credit, probably AAA rated. And some invest down to about BBB. There are also some investments that involve the more risky credits, so higher yields, but a little higher risk in them. So you can get ETFs now that allow you to invest as a retail investor into the bond market. And since they came out, and my former employer Vanguard did bring out some bond market ETFs, they proved very popular as well, because they then gave retail investors access to a market that they really didn't have access to previously.
And I think that's a key. And to those of you, presumably, Angus, most of the people who's going to watch this are not going to be retail investors. But if you are a retail investor and if you are watching this, my personal recommendation to you is listen to what Angus has to say and go and invest in an index fund. Don't try and pick shares. Don't try and be the hero because quite frankly, and I'm sorry for the words, actually, I'm not sorry for the words I'm about to use, there's a high percentages that you will lose. So now you have access to things you didn't have before at a low cost, and you also have access to bonds, which Angus, as you said before, previously you didn't have. You had to be an institutional. So if you can get into index investing ETFs, I highly recommend it. Even though this is not investment advice, you need to do your own due diligence when you make an investment decision. Angus, before we conclude, do you have any closing remarks? This was absolute fantastic, and I'm sure the audience have a lot more clarity, at least those who are not familiar with index and ETFs, about what it is. and what advantages and disadvantages, and how should we even look at one to pick one. Do you have any closing remarks before we conclude?
Well, I suppose, Nitay, that my closing remarks would just be to summarize what I've said and to really hammer home to your audience that the world of ETF investing and the world of index investing, because of the advantages it has of transparency, low cost, and that they track the performance exactly of various asset classes before fees, and their fee is very small, so the amount that you're giving up by investing in these is very insubstantial compared to using an active manager. The safety, the fact that they're exchange traded, and therefore they're liquid enough for people to be able to buy and sell in small or large amounts without the price being affected too much. Are all the good benefits of ETFs. There are some scary stories out there about ETFs and how they would perform in a crash, and most of those, I would caution, are put out by active managers who are trying to discourage the use of these products. So ETFs have been through about 4 market crashes in both the bond and equity market and have come out unscathed. So I think they've proven their worth in both up and down markets, and they can be and that they probably should form a majority of many retail investors' core portfolios.
I agree with you, Angus, because if you're a retail investor and you think that an index fund or ETF, whatever vehicle, but it doesn't work, you're essentially saying the economy is not going to work over the long term. That's essentially what you're saying.
Yeah.
Or the highest performing companies in Australia is not going to perform in the long term, which is, I think, is a silly statement to begin with, but that's for another day. What I would recommend to retail investors who perhaps investment is not their priority on a day-to-day basis is when they do invest, in my view in general, but in particular in ETFs and index, is to remember to be patient, to remember to be persistent, and to remember to be disciplined. Because if you don't have these 3, you're not going to make money, my view, in any investment, but in particular in index investment, especially in the current economic environment. Would you agree to that, Angus?
Yeah, I would certainly agree with that, yes.
Yeah. Okay. Angus, thank you very much for sharing your valuable time with us. It has been an absolute joy and to have someone with your expertise share your knowledge with our audience. And to those of you who watch, I hope you found it very, very beneficial. If you want Angus detail, I'm happy to make the connection. Angus, again, on behalf of the community, thank you very much, and stay safe in Melbourne. I know you're in Melbourne. To those of you who wonder, COVID-19, if you watch it 10 years from now, it is COVID-19. Angus is not in Melbourne, and that's why we don't do this face-to-face. And to all our friends in Melbourne, stay safe. Angus, thank you very much.
Thank you, Nitay.
Thanks. Bye.